Each year in September, the Dutch government announces its new budget plans for the coming year. For the 2024 budget day, the expectations were high, with a new cabinet steering the ship for the first time. And as the Netherlands is currently dealing with vital challenges. Shortage in housing is at a record high. The investment climate has been under pressure, and climate change is an important topic. In its plans, the Dutch government introduced tax measures addressing these challenges. And in this video, I will walk you through the most relevant changes with respect to the investment climate and the most important measures that can impact companies that are doing business in the Netherlands. In 2019, the Netherlands implemented the Expat 1 directive, which included the earnings stripping measure. And under this earnings stripping rule, net interest expenses above a certain threshold are non-deductible. Expat 1 allowed EU member states to apply thresholds up to 30% of the EBITDA with a fixed minimum threshold of maximum €3 million. However, the Netherlands had implemented a threshold of €1 million, or 20% of the EBITDA, which is lower than the EU prescribed. And as you might understand, this was not an attractive measure for companies wanting to invest in the Netherlands. So to make the Netherlands more attractive for companies, the Dutch government has proposed to increase the threshold from 20% to 25% of the EBITDA. And this means that companies will potentially be able to deduct more interest costs in 2025. In practice, what happened also was that companies split their activities across multiple entities, allowing them to use the €1 million threshold multiple times. This practice was common among real estate investors. And to combat this practice, the government has proposed to abolish the €1 million threshold for certain real estate investors. Now, if you are a company investing in the Netherlands and you have interest costs, you might be able to benefit from a higher deduction of interest costs. And if you are a real estate investor, we recommend reviewing how this new measure will affect you. The Netherlands has an expat ruling regime to attract skilled migrant employees. And this ruling provides for a tax benefit where 30% of their salary would be tax-free for up to 5 years. The Dutch government amended this ruling in 2024. In this amendment, the benefit of the 30% ruling was ultimately reduced to 10%, leading to many discussions. During Budget Day 2024, the Dutch government announced to revert these amendments. It is now proposed that as of 2027, 27% of the salary will be tax-free for up to 5 years. And during the years 2025 and 2026, it is proposed that the rate will stay at 30%. Discussions are going on to further increase the rate to be more competitive internationally. To attract more investments in the Dutch housing market, the Dutch government proposed to reduce the Dutch real estate transfer tax rate from 10.4% to 8%. This reduced rate should lead to more investments in the Dutch real estate market, but it remains to be seen whether this measure will have a major impact. Discussions are ongoing that the rate should be further lowered to make a real difference in the Dutch housing market. The Dutch policy for recognizing foreign legal entities can lead to mismatches between two countries. And to prevent these mismatches, the Dutch government introduced new rules. The rules say that we should compare foreign companies to Dutch companies. And if a foreign company is similar to a Dutch company, the foreign company will be treated the same way as the Dutch company. In case there is no equivalent, 2 additional methods are introduced: the fixed method and the symmetrical method. With a fixed method, a foreign company established in the Netherlands will be qualified as non-transparent. This foreign company will be subject to Dutch corporate tax. With a symmetrical method, the Netherlands will follow the classification of the country of residence of the foreign company. In Dutch tax law, two collective investment regimes exist: the exempt investment regime and the fiscal investment regime. Starting January 1st, 2025, only regulated investment companies will qualify for the exempt investment regime. Non-regulated investment companies can no longer benefit from the exemption of Dutch corporate tax. Fiscal investment companies that invest directly in Dutch real estate can no longer use the 0% corporate tax rate. The change in the exempt investment regime is relevant for Dutch investment companies that are not regulated under the Dutch Financial Supervision Act. The change in the fiscal investment regime is relevant for investors who have investments in Dutch real estate. We recommend reviewing your group structure and business model to analyze how this might affect you. The interaction between the loss relief rules and debt cancellations can lead to complications. A loss-making company may end up paying corporate tax on the profits arising from a debt cancellation. And this creates a tax burden that can hinder the financial recovery of a struggling business. The Dutch government has proposed to mitigate this tax burden. Loss-making companies will not be taxed on profits arising from debt cancellations when certain conditions are met. And this proposed measure will benefit companies investing in the Netherlands by removing the tax burden on debt cancellations. The Dutch government wanted to abolish the exemption of Dutch dividend withholding tax on listed share repurchases. This repeal was planned to enter into force by January 2025. However, the Dutch government decided to retain this exemption in 2025. A Dutch CV can be qualified as transparent or non-transparent. Starting from January 1st, 2025, the Dutch tax authorities will always consider a CV as transparent. And this means that CVs will no longer be subject to Dutch corporate tax and Dutch withholding taxes. Dividend distributions are in principle subject to a 15% Dutch dividend withholding tax. Sometimes dividend withholding tax is not due because the dividend withholding tax exemption applies. The distributing Dutch entity might pay the Dutch dividend withholding tax when, in retrospect, it could have applied the dividend withholding tax exemption. In this situation, no appeal can be made against the wrongful withholding and remittance of Dutch dividend withholding tax. From 2025, the application of the Dutch dividend withholding tax exemption will be mandatory, and this ensures that the recipient of the dividend can appeal if the Dutch dividend withholding tax has been withheld incorrectly. For businesses that fall within the scope of the 2024 budget day tax measures, I highly recommend taking a closer look at how these measures impact your operations. And as always, if you have any questions or need tailored advice, don't hesitate to reach out to me or my team.